Right now, the United States owes more money than it makes in a year. Not close to it, past it. The national debt just crossed $39 trillion. The economy that has to pay that debt back is worth about $32 trillion. That means the debt is bigger than the whole country's yearly output. This has only happened one other time in American history. That was during World War II. Back then, the debt came down after the war ended. Nobody is sure what brings it down this time.
Here is a number that matters more than the total debt. The government now pays over $1 trillion a year just in interest. Not loan payments, not new spending, just interest like the minimum payment on a credit card that never goes away. That $1 trillion is now bigger than the entire defense budget. It is the third biggest thing the government spends money on, right behind Social Security and Medicare. Every single day, that interest bill grows by about $3 billion. By the time you finish watching this video, the debt will have grown by a few $1 million just from you sitting here. You do not need to be an economist to feel this. You feel it at the grocery store. You feel it when you check mortgage rates. You feel it when your raise at work does not go as far as it used to. This video is not going to tell you the sky is falling in exactly 18 months because nobody actually knows that, and anyone who tells you an exact date is guessing. What this video will do is walk you through a framework that one of the most successful investors alive has spent 50 years building, show you the real numbers behind it, and give you an honest, grounded way to think about protecting what you have worked for. No fake countdown clock, no made-up crisis. Just the math, the history, and a plan you can actually use. Ray Dalio built one of the largest hedge funds in the world, a company called Bridgewater Associates. He started it out of a two-bedroom apartment. Over 50 years, he studied how money, debt, and power rise and fall, not just in America, but across 500 years of history and multiple empires. He wrote his findings down in books like Principles for Navigating Big Debt Crises and Principles for Dealing with the Changing World Order. His main idea is simple to say, even though the details are complex. Money and credit move in cycles, they always have. And once you understand the pattern, you stop being surprised by it. Here is the plain English version of his framework. Every person, every company, and every government has money coming in and money going out. When more money comes in than goes out, you save. When more goes out than comes in, you have to borrow or you have to sell something you own. Governments work the same way except for one huge difference. A government that controls its own currency can print more of it. That one difference changes everything about how the story ends. Dalio breaks this into two cycles that sit inside each other. The first is the short-term debt cycle. This one is familiar to almost everyone because we live through it every 7 to 10 years. Money gets cheap to borrow, people spend more, businesses hire, prices go up. Eventually, the central bank raises interest rates to cool things down, borrowing slows, a recession hits, then rates come back down and the whole thing starts again. We have lived through about 12 and a half of these cycles since the end of World War II. It is the up and down you already know about. The second cycle is the one most people never see because it only happens once or twice in a person's whole lifetime. Dalio calls it the long-term debt cycle, and it usually plays out over 50 to 75 years. Here is how it works. Each time the short-term cycle dips into a recession, the response is to cut interest rates and add more debt to fix it. That works for a while. But over many small cycles, the total pile of debt slowly grows bigger relative to the size of the economy. Interest rates get pushed lower and lower each time because the country cannot afford higher rates on a debt pile that keeps growing. Eventually, rates get so low that cutting them further does not help anymore. That is the point where a country has to make a much harder choice. And it is roughly the point many economists think the United States is approaching right now, with rates still elevated but debt growing faster than the economy underneath it. When that point arrives, Dalio says a country really only has three honest paths available. The first path is to default, which means simply not paying back what is owed. This is rare for a country that controls its own currency because there is an easier option available. The second path is to restructure the debt, meaning the government and its lenders sit down and agree to change the terms, stretching out payments or reducing what is owed. This happens, but it is slow and painful and full of fighting over who takes the loss. The third path, and by far the most common one throughout history, is to quietly make the money worth less. Economists sometimes call this monetizing the debt. In plain words, the government and central bank create more new money, which spreads the existing debt burden across a currency that buys less than it used to. This does not look like a crisis on the news. It looks like your grocery bill slowly climbing every year while your paycheck struggles to keep you.
I'll pay.
Here is why the third path gets picked almost every time. Imagine a country owes $100 trillion. If prices rise enough that money is worth half as much 10 years from now, the country technically still owes $100 trillion, but in real terms it is now paying back something closer to $50 trillion worth of value. Nobody had to default. Nobody got blamed. The debt just quietly shrank in real terms while the number on paper stayed the same. This is not a conspiracy theory. It is the plainest explanation for why governments almost always choose inflation over default when debt gets too big to manage any other way. Dalio has written about this pattern across the Dutch, British, and American empires, going back 500 years, and the ending rhymes every single time even though the details differ. If you want to see what this looks like in real life, you only need to look back at two periods in American history. The first is the 1930s. Stocks lost roughly 90% of their value from the top of the market to the bottom. Banks failed by the thousands. People who kept everything in stocks and cash got wiped out. The people who came through it in the best shape tended to hold hard assets like gold, along with cash reserves large enough to buy up cheap assets once the panic passed. The United States actually devalued its own currency against gold in 1933, which was the government's own version of choosing the inflation path over other options. The second period is the 1970s. This one is closer to our situation today because there was no banking collapse. It was slower and quieter. The government had spent heavily on a war and on domestic programs, and it had already cut the dollar's last tie to gold in 1971, a moment Dalio has said he personally watched happen while working on the floor of the New York Stock Exchange. Through the rest of that decade, prices rose fast year after year, a period economists call stagflation, meaning prices climbing while economic growth stayed weak. Bonds lost a huge amount of value once you accounted for inflation. The stock market went almost nowhere in real terms for more than a decade. Meanwhile, gold went from around $35 an ounce to over $800 an ounce by 1980. That was not luck. That was gold doing the one job it has done for thousands of years, holding value while paper currency loses it. 2008 is a little different from the other two because it started as a private debt problem, not a government debt problem. Banks and homeowners had taken on too much mortgage debt, and when housing prices fell, the whole system nearly froze. The government and the central bank stepped in with enormous amounts of new money to stop the bleeding. That response worked in the short run, but Dalio has pointed out that it also planted the seeds for exactly the kind of long-term government debt buildup we are looking at today. In other words, 2008 was the moment the private debt problem got transferred onto the government's books, and it has been sitting there growing ever since. So where does that leave a regular person watching this video today? Someone with a job, a mortgage, a retirement account, and a limited amount of time and money to figure this out. The honest answer is that nobody, not Dalio, not any economist, not any YouTube channel, can tell you the exact month a currency's slow decline turns into a real financial pain in your own wallet. What history can tell you is which types of assets have tended to hold their value across these long cycles, and which types have tended to get hurt the most. That is useful information, even without a fake deadline attached to it. Long-term government bonds have historically struggled the most during these periods, because they pay you a fixed amount of money years from now, and if that money is worth less by the time you get it, you have lost real value even though the number on your statement never changed. Cash sitting in a low-interest savings account has a similar problem, since inflation quietly eats away at what it can buy over time. On the other side, a small number of asset types have historically held up better. It is worth being honest about each one, including the downsides, because no asset is magic and no asset is guaranteed. Physical gold and silver have functioned as a store of value for thousands of years, specifically because they cannot be printed by any government. During the 1970s, gold's rise was dramatic, and many investors still hold some as a form of insurance against currency weakness. The honest downside is that gold pays you no interest or dividend while you hold it. It can sit flat or even fall for long stretches, and its price can be volatile in the short run. It is generally treated as a small insurance position, not a way to grow wealth quickly. Businesses with real press. NG Power, meaning companies that can raise their prices when costs go up without losing their customers, have historically done better than the average company during inflationary periods. Think about companies that sell things people need no matter what, or companies with brands strong enough that customers keep paying more. The honest downside is that stocks as a whole can still fall sharply during the disorderly part of a debt cycle. And picking the right individual companies is genuinely hard, which is why many long-term investors prefer broad, diversified stock funds rather than betting on a handful of names. Short-term government bonds and treasury bills work differently from long-term bonds. Because they mature quickly, often in a matter of months, you are not stuck holding a fixed low interest rate for years while inflation runs past it. You can roll the money into a new short-term bond as rates change. This is one reason some investors prefer short-term treasuries over long-term ones when they are worried about inflation. The honest downside is that if the government ever truly struggled to pay its debts, no form of that debt would be fully safe. And right now, treasuries of any length still carry the backing of the U.S. government, which remains the deepest and most liquid bond market in the world. Real, productive assets, like real estate that generates rental income or infrastructure or farmland, have also historically held value during inflationary periods, because rents and land values tend to rise along with prices over time. The honest downside is that these assets can be illiquid, meaning hard to sell quickly if you need cash. And they come with their own risks like vacancy, maintenance, debt used to buy them, and local market conditions that have nothing to do with the national debt story at all. Notice what none of these four categories are. None of them are a guarantee. None of them are a secret four-asset formula that survives everything while everything else gets wiped out. They are simply the categories that have tended, across long stretches of history, to hold up better than cash and long-term bonds when a currency is losing value. A responsible plan uses some combination of these based on your own age, your own goals, and your own tolerance for risk, not a one-size-fits-all percentage handed to you in a video. So what does a grounded, honest plan actually look like? Start with your own timeline. If you are 20 years from retirement, you can afford to ride out a lot of short-term ups and downs because you have decades for your investments to recover and grow. If you are 5 years from retirement or already retired, the same amount of risk means something very different for you because you have far less time to recover from a bad stretch. This single fact, your own timeline, matters more than almost anything else in this video. And it is worth sitting down and writing out honestly before you touch a single investment. Next, take an honest look at what you already own. Are you holding a lot of long-term bonds because someone told you that is the safe part of a portfolio? Are you holding cash beyond what you need for emergencies, letting inflation quietly shrink it every year? Are you holding a handful of speculative positions you bought because they were exciting, not because you understood them? None of this means panic selling everything tomorrow. It means noticing where your money actually is, instead of assuming it is protected just because it always has been in the past. From there, consider building exposure to the categories above gradually, over months, not all at once based on fear. A gradual approach protects you from the very real risk of buying at the wrong moment out of panic. This might mean slowly adding a modest allocation to gold or a diversified fund that holds it, slowly shifting some long-term bond exposure into shorter-term treasuries, making sure your stock holdings include companies with real pricing power rather than only speculative growth names, and considering whether real assets like real estate investment funds fit your goals. The exact numbers are personal. Anyone online who gives you an exact percentage without knowing your age, your debts, your goals, and your other assets is guessing on your behalf, and you deserve better than a guess. Finally, protect yourself from the two emotions that cause the most damage in moments like this: fear and greed. Fear makes people sell everything at the bottom, right when assets are cheapest, locking in the very loss they were trying to avoid. Greed makes people chase whatever asset just went up the most, buying in late after most of the gain has already happened. The long-term debt cycle, if Dalio's framework is right, plays out over years, not days. That means you have time to make thoughtful, gradual decisions. It does not reward panic, and it does not reward chasing headlines. It is worth saying PL. Ainly what this video is and is not. This is an educational breakdown of a well-known economic framework and the real numbers behind today's debt situation. It is not personalized financial advice, and it is not a guarantee about what will happen to any specific investment. Nobody, including Ray Dalio himself, has a crystal ball with an exact date on it. What this framework offers is not certainty. It offers a lens, a way of noticing patterns that have repeated across 500 years of history, so that when you make decisions about your own money, you are making them with your eyes open instead of being surprised later by something that, in hindsight, was actually pretty predictable. If any part of this made you want to look closer at your own accounts, that is a good instinct. Talk to a licensed financial advisor who knows your full situation, not just the part you'd type into a comment section. Read Dalio's own writing directly if you want the deeper version of this framework, since a 20-minute video can only cover the outline. And take your time. The debt did not build up in 18 months, and it is not going to unwind in 18 months either. The most useful thing you can do today is understand the pattern. Look honestly at where you stand, and make one small, considered decision at a time. Thanks for watching. If this framework was useful to you, the most helpful thing you can do is share it with someone who has money sitting somewhere they have not looked at closely in years. Not because the sky is falling, but because understanding how the cycle works is the one thing that never goes out of date.